to make profit through position sizing and system analysis. Position sizing refers to the number of units accounted for invested by a trader. Trading is 80% psychological. That is why even when a trader feels that they have mastered how the market works, they still need to narrow down their scope to the particular market. Good investment involves good system analysis, but if an investor disciplined himself, he doesn't need his analysis to be accurate for the trades to work out fine. Investing is not something that has to be done emotionally. Those who invest according to their emotions usually lose more. That is why the best way to make profit irrespective of system analysis is to settle for a lower number of contracts with much more significant probabilities. That kind of investment can be described as right-sized investment because position sizing has guided the investor on how much to invest and the risk involved in that particular site. The process is usually different from the active type of marketing, where you trade based on the analysis at the moment. It is usually a function of how much you could lose if the strategy doesn't go as planned. Before sizing your trade, it is essential to know how much is in your account and what percentage you have to risk in this system of cross-checking. It is identified as portfolio management. With proper portfolio management, what is in your account and what are you willing to risk is considered. This will help you to place your stop loss at a particular interval before or after a stock goes bad in the market.